The other day, I stumbled across this photo that President Trump posted, and honestly, I had to double take. It showed FDR, yeah, the guy who helped create the 30-year mortgage after World War II. Right next to Trump, and under Trump's picture, the words 50-year mortgage. The caption basically lumped them together as great presidents. Which, okay, that's one way to start your weekend. But here's the wild part. The whole idea supposedly started at a meeting in Mar-a-Lago, where Bill P. from the Federal Housing Finance Agency literally brought a poster board like a school project to the president. He lays this out, Trump likes the picture, and boom, it's up on Truth Social. And now the FHFA says they're working on it. Apparently, that's all it takes. A poster board and a vibe. The claim behind this whole thing is that a 50-year mortgage would make housing more affordable. And I get why that sounds tempting. Who doesn't want lower monthly payments? But the moment I dug into the math, the whole idea fell apart in the most dramatic way possible. So let's walk through it like I did. I started with a typical example of $450,000 home, with a regular 30-year mortgage at about 6.25%. That comes out to around $2,700 a month. And over those 30 years, you pay about $547. Zero in interest. Not amazing, but kind of the reality we live in. Now take that same loan and stretch it to 50 years. Keep the interest rate the same, even though in reality, banks would definitely charge more. Because longer terms mean more risk. $1 million in interest for a $450,000 house. That's when it hit me. This isn't affordability. This is financial cosplay. And that's if the rates stay the same. If lenders bump it up to something like 7.25%, suddenly you're not saving anything monthly. You're just signing up to hand over close to $1.2 million in interest over half a century. You'd save maybe $100 a month, and in exchange you'd be paying off your house until you're old enough to collect birthday cards from the retirement home staff. And then I remembered, the average first-time homebuyer in the U.S. is now basically 40. So if someone starts a 50-year mortgage at 40, they statistically won't even live long enough to finish paying for the house. Forget generational wealth, this turns into generational debt. Then there's the equity problem. With these super long mortgages, almost your entire payment in the early decades goes toward interest, not principal. On a 50-year loan, it takes nearly 40 years before you're finally paying more toward the house than toward the bank. 40 years. Meanwhile, most people move every 11 years. This means after a full decade, you'd barely dent the principal. You're practically renting from a bank instead of a landlord. And the more I thought about it, the more I realized this whole thing doesn't fix the housing crisis, it pours gasoline on it. Whenever lenders stretch out loan terms like in the car market with 7-year loans, prices don't get cheaper. Sellers just raise prices because buyers can afford more. Same thing happened with college tuition. Same thing will happen with housing. A 50-year mortgage doesn't make homes cheaper. It just makes buyers more stretched and sellers more excited. Then there's the risk. If it takes you 30 to 40 years just to get halfway through the principal, even a small dip in the housing market could wipe out everything you've built. It's like running on a treadmill for decades and never actually moving forward, unless the economy never hiccups again, which, come on, you're always vulnerable. And it gets worse when you think about the bigger picture. The whole system would be a legal and financial maze. Investors don't want to wait 50 years for their money. Banks don't want that risk. So they pad it with higher interest rates, more fees, and whatever else they can tack on. This wouldn't make the system stronger. It would make it creak under its own weight. The part that really stuck with me, though, was who actually benefits. It's not the average American trying to buy their first home. It's banks, builders, and Wall Street. Banks get decades more interest revenue. Builders get to charge higher prices. Investors get a half-century of cash flow from someone's paycheck. The only one losing here is the homeowner. Even people in Trump's own party pushed back hard. Marjorie Taylor Greene literally said people would die before paying off their homes, and that the only winners would be banks and builders. When someone that loyal to Trump calls something a bad idea, it makes you think. I kept seeing people online say, well, you could just refinance or just pay extra. But let's be real. Almost nobody consistently pays extra on their mortgage. The stats say it's under 10%, and the people who'd be drawn to a 50-year loan probably wouldn't have extra money to throw at it anyway. So I ended up at the same conclusion the script laid out. No policy is coming to save us. Not this one, not the next one. The only thing that actually works is the boring stuff. Paying down debt, building an emergency fund, saving for a down payment, buying a home you can actually afford long-term. It's not sexy. It's not viral. No poster board at Mar-a-Lago can make it magically easier. But at least it means when you finally get that key in your hand, it really is your home and not a 50-year death pledge. And yes, mortgage literally means death pledge. America would be taking that a little too literally with this plan. As for me, I'm saying no thanks. I'm not signing up for a loan I might still be paying off from a rocking chair at age 90. I'll pass on the posters and stick to reality.